Hi. Well, I'm Ty Carr. I'm coming to you from my garden here in Portland, Oregon, and I'm going to be talking in this video about the three reasons, not the three reasons, but three possible reasons your business could lose its S election. Did your business make an election to be an S corporation for tax purposes? That would be the context of this video. There's a few gotchas if that's the case that can terminate your S election if you aren't careful. The tax law standard is that you have to meet the qualifications of being an S corporation on every day of the tax year. And so what are those qualifications? Well, they're the same criteria you checked off before electing S, and they still have to be true throughout each day of the tax year that you want to continue filing as an S corporation. The three requirements among the things that you check off, which there are a number of issues that mainly deal with the number of shareholders and the type of shareholders that you have. There's three things that I see most commonly companies struggle with that can end up terminating their S election. And those three things are number one, there can't be a second class of stock. And number two, undocumented loans between owners and the businesses can essentially create a second class of stock unintentionally. And number three, the owners have to always be allowable shareholders. So having an ownership change or an inadvertent unallowable shareholder can end up terminating your S election. Now, the second class of stock is by far the most common issue I see S corporations deal with. The meaning of this rule is that all owners have to receive the same right to distributions and liquidation proceeds, and it has to be commensurate with their relative shares of the company's stock. This concept can be a transition for LLC owners who may have previously been taxed under partnership rules. Under the tax partnership rules, it's actually possible for owners to receive distributions in any particular year that are disproportionate in comparison to their percentage of membership units. But once you become an S corporation, you can't do that anymore, because if an S corporation gives its owners disproportional rights to distributions, it has violated the second class of stock rule, which causes an inadvertent termination of the S election. Now, the second issue, undocumented loans, follows from the second class of stock issue. If an owner gives their S corporation a loan, but there's no documentation of the contract or proper interest accrual, that transaction starts to look a lot like equity or a contribution to equity. When the S corporation starts repaying a loan that looks like equity, the IRS can assert that that's really just an equity distribution, and that would be a preferential distribution to one but not all the owners. Thus, it would create a second class of stock. A similar issue occurs if the S corporation makes a loan to an owner and that isn't being properly documented. The act of making the loan could be recharacterized as an owner's distribution by the IRS, which again then would be a preferential distribution to that one owner compared to the other owners, and potentially gives rise to this issue of having a second class of stock. Again, such a distribution, the point being, any distributions to owners that are not pro rata give rise to second classes of stock. And if you have transactions that were supposed to be loans but weren't documented well, and the IRS claims that they're distributions, that's where you get stuck here. Finally, having all owners who are allowed under the S corporation rules to actually be owners of an S corporation can come into play when you're contemplating mergers and acquisitions or employee stock ownership programs. Perhaps your business has the opportunity to raise money by selling ownership to a fund that happens to be organized as a partnership. These are all scenarios where you have to consider, how are you going to manage the one class of stock rule? It is manageable. It is possible to do employee incentive programs that don't violate the one class of stock rule, so it's just something to take a look at. Well, these are all scenarios that could violate or ultimately jeopardize your S election. In many cases, the business is aware that they'll lose their S election, and they've chosen to do these things intentionally, and that's fine. Perhaps in those situations, if you don't mind your S election being terminated, you might plan a voluntary termination on and time it so that you can time your tax returns accordingly without too much disruption. What's important is being aware of the tax outcome of some of these decisions and having done the economic analysis, including the tax effects of these business decisions. Well, that's it for now. I'm going to return to gardening. I hope these videos are helpful and informative, and if they are, please subscribe and please tell your colleagues and friends about them. And I appreciate you being part of this and part of this community. All right, take care.